a downturn economy like we're in now, when the focus is really on cash, we hear from tax directors and other company executives that they don't really want to discuss, you know, tax planning ideas like we have historically, and you know, what do you have in terms of cash? What can save me cash? And so this whole indirect tax area is a perfect opportunity to address that cash issue. Now, when the economy picks up, turns around, we're hoping that because of the success we've had in the indirect tax area, to help companies get cash back, to integrate tax more into the business, that then tax will become more top of mind from a strategic planning perspective in the good times. Tax has not historically been as integrated into overall business strategy as one would like. And there's a few reasons for that, and one of which is the fact that we find that most business unit executives are compensated on a pre-tax measure, and a lot of the income tax planning certainly goes into effective tax rate management. That's all below the line, and so there's not really an incentive in many companies' cases for any of the business unit executives to factor tax into their overall strategy. The reason why that companies have been overpaying taxes to the extent they have has been because of poor data and poor technology. You know, many times they're paying the same tax twice. They can't get to the data they need, so they're estimating, and it's just incorrect amounts, and it's causing all these overpayments. In terms of the order of magnitude, we've seen a major airline company get about $25 million back in savings. We worked with a high-tech company that got $150 million back. So these are very large numbers. And just so you know, people realize, just one example of how this could possibly happen is, if you think of, again, back to a financial service industry example. Say it's a New York-based bank, and they actually purchase all their computers for their people, and they purchase it all out of New York. They're all delivered in New York. But then they're sent out across the country to wherever all the people are. They're typically paying tax all in New York, and what really should be happening is they should be paying a use tax in all the separate jurisdictions. And so it's the rate differentials, it's the duplicate tax payments in many cases. It's those types of issues where companies can't necessarily get down to the specific data required, and so they end up making inaccurate tax payments. And that's what's really happening to cause all these overpayments that we're seeing. So what we would do, or what we would recommend, is we would get a sample of the data. And you know, we have forensic tax accountants on staff that would go through all the sample data that basically just gets downloaded out of the company's systems and look for the overpayments. We would then help the company shepherd through all the refund claims to the various taxing jurisdictions, and parallel to that, we would also figure out what process and technology improvements are needed to be put in place and develop a plan for that. Any type of initiative going on company-wide, it's also an opportunity to do it. Major process projects, shared service center migration, offshoring, new ERP implementations like SAP, Oracle, PeopleSoft. It's a perfect opportunity. Or even in a post-merger integration environment, if the companies have merged together or there's been an acquisition, again, it's a good time to take a look at these processes and look for cash that's been paid. Because we are finding that companies are getting substantial amounts back, and they can fund all or a big portion of these overall projects.